Hi all, Joshua Stega here from etfadvisor.com.au, and today it's time for our usual weekly rundown of the Aussie ETF market. And we've got quite a bit to cover today. So what I'll be looking at today is the Aussie market and why I think that's right on a inflection point, and it could go either way here, and I think we've got to be really, really cautious. So that's the first thing I'm going to look at. Number two, I'm going to look at the US market and what elements we want to see, what elements are in place and what we want to see for that Santa rally to occur. And number three, I'm going to show you what I'm looking at and no one seems to be talking about, but they're absolutely setting up perfectly. Some of the best performing sectors, themes, and no one's talking about it. So that's where I see the really big opportunity going into end of year and into next year as well. So let's get started here with the Aussie market. And I actually put out a special report on my Substack. It was free to everyone, so including free subscribers, and basically just saying Aussie bear market looks like it's incoming. And look, the big change has been that cash rate and really caught everyone off guard. I certainly was of the opinion that interest rates were far too low, and this is actually the 27th of November. So latest data shows actually the chart's now up here. So we're looking at interest rate rises next year, and I think that's really taking the steam out of the market. So what actually looks okay? Resources, that looks good, and everything else is looking really weak. And we've got to remember, materials and resources are only 20% of the market. So that can't hold up. 20% of the market can't hold up 80% of the market. So you're going to have a look at, other parts of the market. You've got the ATEC 200. It's right at that inflection point. So we'll look at that. Financials look weak. Healthcare, it just does not look good at the moment. So they're the big elements of the market. There's financials at 30%. You've got healthcare 7%, industrials, really not looking good. So it's basically going to hold that low, or we're going to go much lower and really quickly. And it's really just an Australian specific issue here. And I think it comes down to the economy and just that mismanagement. So let's have a look at the ASX 200, and you can see, it's kind of held that 200-day moving average, but that's that low. If that low drops, we're going much lower and very quickly. And I don't think it's out of the ordinary that we're going to get, down to these levels, even test that tariff low. And, in terms of actual how far that'll fall from here back to the tariff low, that's about, that's 16%. So bear market territory is, so we're already off about 5. We could fall another 15% to get to that 20% correction. So that's back down to 7,300. So it's a really significant potential correction if a bear market does unfold. And as I said, the resources look fine. Resources look good. And the big thing this week is we finally got BHP. It's spent the first week outside of this weekly consolidation, and that's really impressive. It wasn't too long ago it was at the 200-day moving average and just had a really strong move, and now it's at a high. So you're probably going back to 7th of October, so a bit over 12 months high at the moment. So pretty impressive. It's had a pretty good bounce really quickly, maybe some back and fill, but that space looks really good, and that's all I want to know about in the Aussie market at the moment. That's uptrending. That's 20% of the market. The other 80% is looking really, really challenged. So let's have a look at the financials, and this just looks terrible. And that basically coincided with the change in the interest rates outlook. So basically, we're already off kind of 9% in just over a month. And for that to pull back, another, 20%, you're gonna come down into these levels. And that's the thing. If it can't hold this low, it's going straight down there, and it's going to go down very quickly, because this is a sign that already, the smart money is starting to sell. So let's have a look at something like CBA, which will be the biggest holding in the financials. And you can see that kind of change in character, more so on the weekly chart, where it's just been pretty consistent green bars, bit of selling, green bars, green bars, green bars, green bars. Then all of a sudden, you've had earnings here, and we start to get a bit of a change of character where you're getting months where there's some selling, And then you had this further earnings announcement here, and it's just had 3 really big months of selling, 3 big weeks of selling. And, it's stuck under these moving averages. So it's looking really dire. There's 2 paths from here that it kind of can recover and get out of there. But what's the catalyst for that? Or it's just going to do that, and it's going to do that really quickly. So that's the thing. Blue chips are certainly not safe at the moment. And this is going to cause a really big shake-up in the Aussie ETF or in the Aussie market, because people just have such big exposures to some of these. So you look at CSL, I mean, downgrade. So you already had 3 downgrades, and it just can't rally at all. But people are out there buying. People just have no idea. You're buying something in a really firm downtrend. Why do I want to touch that? I want to be in BHP. I want to be in Rio. I want to be things that are uptrending. I don't want to be things that are under the 200-day, under the 50-day, under all moving averages that just look weak. A huge change of character, just all back-to-back selling. So this is smart money exiting. Where's the buying going to come from, and why? So that's the big issue at the moment. And then have a look at ATEC. That's already off 20%. And that's the thing. ATEC had been one of the top performers, but really these aren't technology stocks of any real note. I mean, the biggest holding in ATEC is Computershare, which was probably a handy tech stock, 25 years ago, but this market's already off 20% from the highs. And look, it just can't rally. And just look at that change in character since kind of September. You've just had big weeks of selling. So that's the smart money getting out. And you kind of saw that back before the of tariff correction, where you could see that selling coming through. Then you had a bit of a rally, but it was on low volume, and then boom, back-to-back selling. That was a tariff correction. But we're looking at much the same at the moment, and I can't really see a catalyst for this. Because these tech stocks, they're not in AI, they're not in any of the key sectors. You've got things like WiseTech, you've got Computershare. These things really aren't that exciting on the global scheme of things, and they've had an exceptionally good run of late. So yeah, you can already see the smart money exiting. And then we'll have a look at industrials as well. So this is the OZXX's global X Australian X financials and resources. So this is the index without financials, without resources, and just look how weak it is already. And it's exactly the same pattern. It's under the 200-day, it's under the 50-day, it's under all moving averages. It found resistance up at that moving average. So it's just setting up now. If it can't recover here, but by the end of the year and get some kind of rally, or at least hold, this low, if it breaks this low, boom, it's going much lower and really quickly. So I'm super concerned about the Aussie market, but no one's talking about it. So I'd certainly encourage you to sign up for my Substack, and you can kind of see the report and what I've outlined there. And I'll do a few more follow-ups there, on a free basis. But obviously we'll be giving the best insights to subscribers, but certainly worthwhile signing up just for a free membership to keep, I'll keep you posted on what we're seeing, because it can all change. Basically what we want to see for all these indexes just to hold here and then rally, and then boom, it's looking a whole lot better. But we're right on the edge, and if it doesn't then hold this low, it's going lower. It's going to those to those tariff lows, and and it certainly looks like we could be in for some real trouble if we don't get a Santa rally. So that's what I'm looking at in the Aussie market. Reasons to be cautious. As I said, I don't want to be in anything but resources. I mean, look at MVR here. Fine, absolutely fine. Uptrending. We've had quite a few of the resources, base metals and futures pricing breakout. And look at that. Why would I want to be in CSL when I can buy that? No one's talking about resources. It's breaking out. It's trending. It's where I want to be. You look at something, well, obviously, which we've got in the model portfolio. Wire. Copper's just broken out. Why on earth would I want to be buying WiseTech when I can buy copper, which is a key resource for, obviously going forward, just in terms of AI, robotics, all, the further electricity requirements that we need for all this for the future. And it's broken out at all-time highs, and no one's talking about it. It's starting to trend. Why would I want to be buying, ATEC. Why would I want to be buying CBA when I can get access to these? So that's the thing, and no one's talking about it at the moment. But once again, 20% of the Aussie market is materials. That can't hold up the 80%. So it's a really big inflection point. We're watching that over the next couple of weeks, and the volume's just going to dry up. So if you haven't made a decision and you haven't got out, we could be stuck into some really wild trading coming into end of the year, and the market's pretty much dead to Australia Day. So you've got to be very, very cautious. I think people are already packing up in terms of volumes in the market. So you've got to be very, very cautious on the Aussie market at the moment. So two paths, and this is what I've outlined to subscribers. It's either going to play out like this and it's just going to tighten up and rally, or alternatively, it's going to do the opposite, and that's very much set up at the moment, because it seems to be stuck under this moving average at the moment, which I think is the 20-day moving average. There's your 50-day, there's your 200. So it's above the 200 is a good sign, but it's below the 50. And so therefore, it seems to be getting stuck here, and then all of a sudden, all we need is that through that low, and it's, as I said, look out below. I think it'll drop 5 to 10% very quickly. And that's going to happen at very low volume time of the year. So be very, 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 very cautious, the Aussie market. And that's why we're looking at ETFs. We've got so many opportunities. Why would I want to be in the Aussie market at the moment? It just baffles me, but that's all, that's the only investment universe some people know. And it's just crazy. I mean, I'd just be in resources at the moment, the Aussie market, nothing else. So now let's look at the US market, and things are looking a lot better. So, we're looking, it was quite worrying back there, but it was within the usual, movement of things in terms of the seasonality. So it tends to be, volatile around that kind of start of the year, February, March, which happened, obviously the tariff correction. And then, typically through October, November, it's quite volatile. So our big point was, if this breaches and starts rallying up, we're going to get a further correction and look out. But the VIX, this is the volatility index, is settled right back down under all those moving averages. So boom, big tick. The pressure's really off. And what I liked about the US market at the moment is those small caps. So I'd be very, very happy. The small caps have bounced really nicely, and this looks like a really nice base here now on the weekly chart. And I'd be very, very happy for that to lead us out from here. And it seems to be happening, because if you have a look at the NASDAQ, it's nowhere near as strong at the moment. So I'm very happy for other parts of the market to start getting some money, in particular the small caps. So that looks good. And then you've got like equal weight S&P 500, and that also looks good. I mean, obviously wasn't looking good there. Boom. Test those previous highs, and now rallying, maybe a bit of a rest, and then perhaps later next week or the week after, we're going to get that rally. That would time it perfectly with that kind of Santa rally. And then you look at some of these other, I've got something in terms of my weekly email. Obviously, free subscribers get the preview at the top, but I do have a bit of a rundown on kind of sentiment. And this is one thing I'm looking at now is, in the US, you've got a high beta ETF. So this is basically stocks that are, moving under momentum, and that's at new highs. So that's another tick. You've also got a momentum factor ETF that's recovered nicely. Obviously more work to do, but that looks good as well. So in terms of risk on, it's looking pretty good. I'm very happy with the setup. I mean, I think it looks good. I think small caps is the key. And if that leads us out, I think we've got a perfect kind of Santa rally unfolding in the US. But, as I said, it's not so good for the Aussie market. So let's have a look just in terms of those performance numbers. So this is over the 1 year, and this is priced in US dollars. And guess what's down here at 4.07% for the 1 year performance in US dollars? Well, let's have a look. Blue, that's the iShares MSCI Australia Index. So we're significantly underperforming. There's the S&P. There's Canada, which is a resource economy like ourselves, and it's beating us by like a multiple of 5. Like just incredible stuff at the moment. Then obviously you've got Asia there with Hong Kong, China, and then you've got the really key resource economies, Peru, Chile, Brazil, which haven't done much for a long time, but they're up, 63%, 53%. There's little old Australia at 4%. So we've got, and we were rallying pretty nicely with all of them until, kind of that September, October period. And clearly there's something changed. And what I put that down to is the inflation and the interest rate expectations. And that's, we're already seeing a lot of retailers downgrade in Australia as well. So while the US market looks good and resources look good, the Aussie market, as I said, going back to that first point, just doesn't look good. So be incredibly, incredibly cautious here. And I'll try and keep even free subscribers updated with what we see in that space coming over the next few weeks. But as I said, that volume's going to drop off really quickly. So I really want to have eyes in things that are uptrending. So the US looks better, resources look better. So what else am I looking at the moment? There's a 0.3. What else am I looking at in global markets? Well, India looks really interesting, basically back to highs, but we don't have any ETFs that we can play, because part of why this is moving is they've got a weaker currency, but it's coming out of this really long base, which we thought would happen around this time. But there's just no way to play it. I mean, one way that we had previously played it, which didn't work out, but we didn't take a big loss on, was Grin. But you can see that's just not performing. So that's saying us that the currency is just not playing out for us. But if we had a look at if a hedged option, you'll see it's going to look a lot better. So INDH, this is only in the US, but you can see that's pretty much tracking the Indian index because it is hedged. And so currency is a factor. Something to keep in mind as well, because I think the Aussie dollar is also going to strengthen here as well. And that's something to keep an eye on. But at the moment, it's not too concerning, but that can start to have an impact on ETF prices. So that's something we look at for subscribers as well. So we like India, but there's no way to play it at the moment, but something to keep in mind. What else looks good? Japan. So we know Japan's an absolute basket case in terms of their economy and bond yields and inflation and everything that's happening there. But this setup is unmistakable. That looks really good, really constructive. What's the reason? Well, people don't want bonds. They don't want cash. They don't want any other assets. They're just going to run into the market at the moment. And that's the best place to put your cash. So put your money. So that's why that's setting up. And then also we've got South Korea as well, starting to look really interesting, much the same kind of setup. So if that starts to move out of there, and that's already one of the top performers this year, as is actually a proper tech exposure with all the, data storage companies and which obviously plays into AI as well. So that's interesting. China also setting up, been waiting for this for a while. This is a nice weekly base here. And it's just a matter of a catalyst, and the same kind of setup. If it can move out of there, China back on. No one's talking about it. One of the top performing markets. I mean, it's double the performance of the US market this year, and still no one's talking about it. Here you've got Hong Kong. Also looks really good. Beautiful long weekly base. Cup with handle there. Just ticks all the boxes. We've just got to get a catalyst for it to drive out of here. But if it does, boom, that's another place where I want to be, and there's certain ways we'll be playing that. And it looks pretty exciting, to be honest. I mean, obviously a big stock over there is Barber. Look at that, beautiful weekly base, cup with handle. Had the higher volume, then lower volume in the handle, just settling back in. Needs a catalyst. If that pushes out, boom, I think China, Hong Kong are away. And I think there's some easy ways to play that from Australia. So that's a few of the exciting spaces we've got our eyes on at the moment, and easy ways to play that with ETFs. And then, of course, resources. And there's so many different ways to play that. Obviously, we've got wire. We've added that into the model portfolios, because look at copper. Copper's just breaking out, and no one's talking about it. So there's copper. And this was the tariffs they put on in the US, and look at copper just moving away, boom, moving out. Then also you've got natural gas. So you've got resources in terms of their underlying price starting to move higher. No one's talking about it. So this is natural gas, a big, 3-year long base. It's moving out of that, huge volume, boom. Why aren't Why isn't anyone talking about it? We've got so many different ways to play these resources in Australia with ETFs. It's super exciting, and no one's talking about it, and people are just talking about CSL, CBA, WiseTech, why they should be buying it. I mean, it's just unbelievable at the moment, considering the options that are playing out globally. So I'm really excited by Asia. I think that's an inflection point, but I'm leaning more bullish as opposed to Australia, which is at a very clear inflection point, but looks much more bearish. And then we've got all the resources. The resources are starting to look really good, and you're looking at all sorts of moves. I mean, Glencore is an example that is competitor to BHP and Rio, and that's just been languishing for so long. Guess what? It's out of that downtrend. It's coming out of that stage 1 base. There was your kind of breakout, and I expect that to trend from here. So you've got that. You've got Rio looking really, really good. So once again, long base, and this is a stage 1 base, first week above it. Plenty positive change of character, a lot of green bars, a lot of buying. Very happy. Boom, new CEO, change of management. A lot of potential there. So some really, really exciting spaces. So obviously there's a heap of different ways to play it. The ones we've already got in the portfolio. We've got Wire. We've got some XMET. That looks really good as well. Been a top performer. Really nice setup. Could look to add to that. And we've also got, obviously, QRE, which is resources sector, which just had a pretty good finish on Friday. And that looks really constructive, starting to trend, broken out of this long base, tick, 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 tick. Very happy to be there. So we've got, I think, about a 40-50% exposure to resources in our model portfolio at the moment, and very little exposure to Australia. And even in our income portfolio, for the first time in a long time, we have reduced our exposure to Aussie dividend-paying ETFs just because of the weakness. I mean, look at this. Even VHY, which has been a real top performer in that income space, it's at that inflection point. Can it get through that 50-day? I'm not confident that it can. And therefore, if it breaks this low, doesn't matter if you're in for yield or whatever, if the Aussie market goes down, be very, very cautious. So there's other ways to play yield and things like that are going to give you global dividends. I mean, why would I be in VHY when I could be in WDIV, which is uptrending, just about at new all-time highs? I mean, tick. Why would I want to be in the Aussie market when I've got things that are uptrending? So that's where we're at the moment. Some really, really, really key inflection points about to unfold over the next couple of weeks. And I think there's going to be huge upside if you know what you're doing and you're not wedded to Aussie market, blue chips. You're looking at a global portfolio of ETFs and the opportunities that are available to you. I think you're going to do exceptionally well here. So very exciting times for ETF investors. I urge you to sign up. I'm going to, as I said, do more free reports. But even, you get even in my weekly, you get the first part of the email, and you'll see, my different sentiment indicators, which I've just introduced, showing you exactly where we're at, what the take is on our market from an Australian perspective, as well as globally. So really important information there. Love you to sign up, and thanks for listening again. And remember, follow the trend.